Well, those were the top headlines, and let's take a look at how the markets fared last week. In global energy markets, they're grappling with severe volatility as crude prices face a turbulent tug-of-war. Brent crude settled near $88 a barrel for the week after a series of U.S. military strikes on Iran shattered a brief June ceasefire. Heightened geopolitical risk in critical maritime corridors has reignited supply disruption fears, offsetting weaker global demand signals and putting central banks on high alert over sticky inflation. Meanwhile, in Asia, Tokyo endured a brutal session on Friday. The Nikkei 225 plummeted 4% to close below the 65,000 points mark, officially entering the correction territory as it sits more than 11% below its June record high. The sell-off was primarily a vicious unwind of crowded semiconductor and AI-related positions. Massive drops in chip equipment heavyweights dragged the price-weighted index down, with even a weak yen failing to rescue exporter sentiment. In contrast, India's domestic markets showed resilience. The BSE Sensex rallied over 1,000 points to cross the 78,000 mark, propelled by robust quarterly earnings in the tech sector. That's highlighted by a strong profit surge from Tech Mahindra. Buoyed by this equity strength, the Indian rupee also appreciated by around 14 paise to trade at the 96.28 mark against the US dollar. Though persistent FII outflows and elevated oil import costs, they mean that the Indian currency trades close to its lifetime lows. Shifting focus now to European equities, which opened lower on Friday, with major indices in Germany and France slipping close to 1%. Investors are balancing West Asia inflation risk against a strong corporate earnings season, particularly from major European banks. Looking ahead, Wall Street is also bracing for a tense opening next week. This follows tech-led declines in the previous sessions, while Apple overtook Nvidia again to top the most valuable company charts. U.S. futures, they remain highly sensitive to volatile energy prices and the ongoing pressure on global semiconductor stocks as well. And for more on this and the market picture going forward, we are now being joined by Mr. Ajay Bagga, who's a market expert joining us live from Mumbai. Mr. Bagga, welcome to the broadcast. Thank you for joining me today. Firstly, let's talk about the Indian markets. Your first thoughts, how do you see our markets still focused on geopolitical events which are continuing to escalate, or do you think earnings and fundamentals, they have now become more important in terms of direction for the Indian market?
Yeah, see, in the very short term, geopolitics overlays earnings and fundamentals. But in the medium to long term, we have to deliver on earnings to justify our valuations and get the foreign investors back into India. So right now, there is an overlay of geopolitics, but we have seen Indian markets perform well because earnings have been strong across a number of sectors. Banks have done well. Technology has been in line, but not disappointing. Pharma is expected to do well. Oil and gas is doing well. So we've seen quite a few sectors give robust earnings. That's helping the Indian markets. But we must remember that in March, we had seen 122,000 crores, nearly about $12 to $13 billion of foreign outflows from India at the peak of the US-Iran war. So if geopolitics heats up, we do see a lot of global risk of appetite spoiling the flows for the Indian markets.
Right. We'll talk about global appetite in just a bit, but specifically talking about the tech sector, you just mentioned that it's doing decent. It hasn't been disappointing. Tech Mahindra earnings have been decent. So how are you seeing the tech space in India right now? Do you think the sell-off in Indian tech stocks, that's been overdone, or do you think there's still more downside left?
I think we are very much near the bottom on the Indian tech stocks in terms of valuations. What has happened is the markets have preferred over the last 2 years more the hardware sector rather than the software. So the semiconductors and the AI momentum plays have got most of the investments, and software globally has underperformed. Now we are reaching a space where a lot of AI investments have happened, are still coming in, and people are asking where is the revenue? And the revenue providers will be IT services companies, the software, which will enable this AI hardware to be used by companies to generate better productivity, cut costs, or generate higher revenues for the same amount of investment. So we are waiting for that, and we think Indian IT will now benefit from that surge, and we could see better prospects ahead for Indian IT companies.
Okay, so better prospects could be ahead for the Indian IT services sector. But Mr. Bagga, how would you comment on the global picture? You were just highlighting how AI-related stocks have now started to fall. But over the past month or month and a half, it's been like a seesaw for tech-related stocks. They've been rallying. For instance, SoftBank in Japan, it saw a rally of about 11% and a similar downfall as well. So what are you making of the global picture when it comes to tech stocks?
See, over the last 2 years, there's been a very concentrated move in markets. So the global markets have been carried forward largely by the magnificent seven stocks in the US, the hyperscalers in AI, the semiconductor companies, and the big tech beneficiaries. Now, what has happened over the last 2 months, we are seeing a bit of questions being raised on AI. And if you look at the semiconductor index in the US, it's 20% down from its all-time highs. So it has entered a bear market. But if you look at the equal weighted S&P 500, which ascribes an equal weight to every stock, that's at an all-time high. What does that show you? The money is not moving out of the markets. Money is rotating out of big tech into more value-based companies. And also, where is the growth? The money is going there. Like banks in the US had blockbuster earnings for this quarter, both on equity trading as well as the investment banking revenues on heightened IPOs and heightened mergers and acquisitions. So money is rotating out, but not going out of equities as such.
When you say it's rotating out of tech for sure, but going forward, do you still see any particular sector to pick up, or do you think it's going to be a broad-based rally, if at all?
Well, I don't think the tech story is also over. So people will wait for the earnings and the management guidances from the hyperscalers and the Max 7. I think that will then determine more dip buying coming in. There is enough money on the sidelines. It is not in bubble territory. Yes, say something like SpaceX, which was 90 times revenues, we have seen a sharp fall and it's come below even its IPO levels. So I think tech story is not over. We will see a return to the big tech story coming in post the earnings when the market has gauged. Right now, it's been a sell-off. So sell on rumor, and there will be a buy on fact, which will come over the next 3 to 4 weeks.
Okay, so we'll keep watching for that picture over the next 3 to 4 weeks. Our tech story, like you said, is not over, and it is likely to see a comeback once the earnings are over, and that it's not in the bubble territory anymore. So that's about the tech space. But Mr. Bagga, I would also like to talk to you about a little bit of the commodity space. Gold has fallen below that symbolic $4,000 per ounce level this week. Do you see prices correcting even further? What is the trajectory going to be like over the next few weeks?
Yeah, gold is really suffering from a lack of pure demand, I would say. Secondly, there's a difference between the physical gold and the financial gold. Physical gold is still seeing very strong demand. If you see jewelers in India, they reported 20-30% year-on-year growth in revenues. As their earnings come out, we will get a better idea. But despite the 15% custom duty that India put in, we have seen the jewelry offtake continuing in India, for example. So, in short, why is the gold suffering? Because of the inflation globally, because of the geopolitical issue which has raised the oil price. So, gold is afraid that rates will go up, and gold being a non-yielding asset, you don't make a fixed return on gold. It is negatively correlated to interest rates. Moment we understand that the oil issue is over, the geopolitics starts calming down, you will see gold rallying again. We see gold hitting $6,000 sometime next year, probably in the second, third quarter of 2027. So gold is a good asset to have. 5 to 10% of your portfolio must be in gold.
All right. Thank you so much, Mr. Baga, for sharing those thoughts. $6,000, that could be the next target next year, maybe in the second or third quarter. That's the word coming in. Thank you so much for all of those insights. On that note, I'll let you go.